Hey everybody. In this lecture video, let's take a look at topic number 13. So I'm going to bring it over here so everybody can see. All right, topic number 13 is about compound interest. So what is a compound interest it's a most fundamental basic formula for things like investing, okay, savings, your certified deposit, the CDs that offer at the banks, or something called a money market account. So whenever I use the word money market account, it's referring to things like stocks, especially mutual funds. Okay, so most of the times that folks 401k is actually being spread out, or the word diversified, invest into different stock markets. Okay, and sometimes some of your money is actually invested into a higher risk of accounts or companies. Sometimes it's also being diversified into a safer company. That means the growth of the company is actually slow. Okay, the company being around a long time. So the word diversify simply means taking your 401k money and then spread it out into different types of a mutual fund or stock market accounts. Okay, so most of the time when I'm talking about money market account, I'm more referring to mutual funds, because mutual fund is actually in long term, mutual fund is actually a little bit lower risk. There are risk involved. As you know, sometimes the stock markets go up and down quite a bit. But throughout throughout the mutual fund, whatever the mutual fund account is, okay, throughout time, mutual fund account is normally, the average pretty well. The average interest rate earned for the customers is pretty well. It's pretty steady. Okay, as a it kind of disregard what's happening at the stock market every day. It's about looking at it in the long run. So remember, as we mentioned before, making money is actually not it's actually not a sprint. It's more of a marathon. So in other lecture videos, I will show you a formula, an example I created, how we can actually investing money and see how the account is growing throughout time. All right, but for right now, let's take a look at this compound interest formula. Compound compound interest formula actually come from the simple interest formula. So I'm going to give you a quick example here. So imagine we have a principal of $100. Okay, the interest rate is at 10%. So that means at the end of the year, if I use a simple interest formula, the interest you will earn, it will be $100 times zero point 0.1 times 1 year. So at the end of the year, you should earn, well, hang on a second, let me turn on my calculator real quick. At the end of the year, the interest earned will be $10. So the total amount of money, or the future value at the end of the year, the end of the first year, will be 100 plus $10. So imagine we are not taking this money out of the account. Okay, let's say we invested at 10%. I start out with $100. So let's continue into the next year. So the second year, if I do not take any money out of the bank account, that means my principal will be $110 at the interest rate still 10%. So that means at the end of the year, at the end of second year, I will take my $110 times 0.1 times 1. Then the interest I will earn at the end of second year will be $11. So it's actually money grows on money. Okay, that's the idea. So the first year I only have $10 interest because that's only off the principal $100. But the second year I earn one extra dollar, okay, because the principal I was using was $110. So imagine we continue. So now walking into the third year, okay, now the third year, my principal should be, well, the future value at the end of second year, my account should have $110 plus the extra $11 I earned. So now what's in my bank account is $121. Okay, let's do this again for 10% interest rate. So the interest I will earn now is off the $121 times 10%. And this kind of also, shows people that, hey, if you do have a 401k and people are asking you to borrow against your retirement, your 401k account, well, if the money is sitting in that account, that means that money is periodically, okay, earning interest for you. So if you're taking out the interest on top of the interest money you earn out, then that account is not going to grow as fast. That's the reason why, I don't, I seldomly recommend people borrow against their retirement, okay? Because the idea of a compound interest is interest add on to the, to the principal. You have all these money building up, keep on earning interest on top of one another. So it's not a good idea to all of a sudden stop earning all those interests, take the money out, for something that, you can probably save money to purchase. So imagine now is $121 times 0.1 times 1 year. Now, the third year, I actually begin to earn $12 interest. So don't forget now, the growth is not very big because ultimately, after the end of the third year, I only put in $100. I am not adding any more money into this account. It's interest grows on interest. So now my future value is 121 plus $12.10. So that's actually $143 or $133.10. Okay, so at the end of 3 years, I actually earned worth $33.10 worth of interest. And again, it doesn't grow very fast for the simple fact that I only put $100 in here, okay, and haven't add any more money to it. So it's basically an compound interest, is basically an what we so call the exponential explosion on your money. Imagine a tiny little snowball on the top of the hill. As we roll the snowball down the hill, what will eventually happen once it's reaching all the way to the bottom of the hill, the snowball gets bigger. Okay, it has that snowball or exponential explosion on your money effect to it. Okay, that's what these, that's the reason why if you look at the compound interest formula, it actually has an exponent to it. It creates an exponential explosion on the money. So compound interest is interest that is compounded based on both the principal and the accrued interest. Accrued means interest add on to the previous year's principals as additional principal at each interval. Okay, so interest add on to the previous year's total amount, and then that becomes your new principal walk into the next year. All right, so let me kind of quickly tell you what these letters stand for. A stand for future value. So future value in this particular instance is referring to the total amount of money that has been accrued after compounding. So this is how much money is in your bank account at the end of the compounding period or intervals. All right, so we're not borrowing money, we're actually investing money. P is the principal, your initial investment. R is your simple is your interest rate. It can also be APR. Sometimes this example I use do say the word APR here for the rate. Time is T stand for years. The lowercase n stand for compounding intervals. How many times that account roll over? How many times that the interest is being calculated, then add on to the principal. So whenever you say compounded annually, that means the account is rolling over once a year. Annually is one time a year. So the n is going to be 1 in the formula. Semi-annually means n is 2. So that means the account actually mature and then interest add on to the total amount that was in your account twice a year. Okay. Quarterly means 4 times a year. The account roll over 4 times a year. Monthly is 12. And daily is supposed to be 360. Well, let's just use 365, okay, for our examples here. Okay, so how do you know when to use compound interest formula? Well, compound interest formula, you know, will be used when the application problem says the word compounding. Okay, it got to give you a compound period. Okay, so before we talking about simple interest formula, well, those examples has the wording simple interest in them. That's how we know to use the simple interest formula. For these problems, when you see the word compounded, that means we're going to use compound interest formula. All right. This thing called the continuous compound interest formula is very, very unique. Well, even though we're not going to do any example on it, but I would like to show, like to kind of show you there is a formula for something called the continuous compounding. Continuous compounding is basically saying that for every moment of every day, every hour, every week, every year, okay, your money is being compounded. Okay, it continues, it never stops. It's always compounding. It's different than the annually, semi-annually, because those compounded period means only once a year. Okay, the interval is once a year, twice a year, 4 times a year. Continuous compounding means it never stops. It basically have, the compounding interval period is continuous. Okay, it's every moment. The money is actually grow on money. All right, so let's try some example. Okay, I got 3 examples here. Real easy. A couple deposit $22,000 into an account, earning 7% annual interest for 20 years. Okay. Find the future value if the interest compounded daily. So when you see this word compounded, that means we're going to use the compound interest formula. A equal to principal times parenthesis 1 plus R over N, whole thing raised into the N times T power. When you see the word daily, okay, that means my N is 365. So every day, compounding every day. The account roll over every day. All right, so let's see how much money will be in our account after 20 years. So initially, I started with $22,000 times parenthesis 1 plus interest rate at 7%, 0.07 divided by compounding daily is 365, holding raised into 365 times 20 years. T got to be in years. So remember, the 365 times 20 is on the exponent. So in a minute when I key it in, I better key it in the parenthesis. I want the calculator to do that computation for me. So I want to make sure the 365 times 20 is in the parenthesis. All right, so let's give it a try. $22,000 times 1 plus 0.07 divided by 365, close parenthesis. All right, exponent, use the caret key, and then open another parenthesis for the 365 times 20. So at the end of 20 years, I should have $89,202.43. Okay, so that's the answer. Now, what happened if I did not put the 365 times 20 in the parenthesis? That actually means I'm raising to the 365 power first. Then whatever that answer is, times by 20. So which will actually give you what? 471,000, which is incorrect. Okay, so make sure that 65 times 20 got to be, the exponent got to be in the parenthesis. Okay, so 89,202.42. $0.42. Okay, so you might say, well, why is only 89,000? Okay, 20 years later, this account earned me about $67,000. Why, that's not a lot. Well, I agree, that's not a lot because remember, you have not put any more money into this account. It's basically you put $22,000 in this account and you basically forgot about it for the next 20 years. And then all of a sudden, when you looked at it again, that 22,000 becomes 89,000. Okay, but you haven't put any more money or taking any more money out. So it doesn't grow as fast, okay, as compared to like your 401k or your any other type of retirement fund you have, because those retirement fund is being funded all the time, okay, from every paycheck. If you get paid twice a week, that means if you get paid twice a month, that means your 401k is being funded twice a month. Okay, so imagine 12 months, a year, that means you're adding into your 401k 24 times. So that kind of accumulation of principal plus the interest that you earned throughout the entire year will definitely help you grow your retirement much quicker. At some point in time, there's going to be an exponential explosion on this money, because compound interest formula, and we never talk about this before, there's a graph. It goes kind of flat at the beginning, all of a sudden it shoots up. So think about the X direction is years. Think about the Y direction is money. So the money is not growing that much, but then all of a sudden, after so long, all of a sudden it jumps a lot. So once I pulled out my example in the next few lecture videos, you'll begin to see the power of compound interest formula. All right, try another one. Suppose that $14,000 is deposited for 6 years at 5% APR. Find the interest earned if the interest compounded quarterly. So I see the word compound, so that means I got to use compound interest formula. N times T. And when I see quarterly, that tell me my account will roll over 4 times a year, N is 4. So let's take $14,000 times parenthesis 1 plus 0.05 divided by 4. Then the whole thing raised into 4 times T is got to be in years. So let's say if this is 6 months. Okay, so just like simple interest formula, you have to say the T will become 6 out of 12. Okay, you got to convert your time into years. But if it give me years, if it already given me years, I just punching 6 where the T is. I'll put this in the parenthesis. So let's see, $14,000, 5% interest, 6 years later. So that will be 14,000 times 1 plus 0.05, divided by 4, close parenthesis, caret key for the exponent, open parenthesis, 4 times 6. On the end, I will get 18,862. 18,862 and 91 cents. Okay. Find the interest earned. This question says find the interest earned. Earlier, this problem is asking find the future value. Find the future value means find out how much money will be in your account at the end of the compounding period. This one is finding the interest. So inside this $18,000, it has both my principal plus the interest. So to find the interest, I will just take this 18862 91 cents and minus my 14,000. So that tells me this account just earned me $4,862.91. Okay, so read the problem carefully. This one is asking for the interest. All right, let's take a look at inflation. Inflation is compounded once a year. It's also using compound interest formula. When you hear the word inflation, you got to use compound interest formula. Okay, and it's only calculated once a year. United States average three other recent years, inflation is sitting at about 5%. Okay, we have a 5% with the inflation, and there are different reasons of the cause of inflation. Sometimes is demand. Okay, demand-driven inflation. So that means there's too much money out there, but not enough goods. Perfect example will be, during hurricane time, during the time of hurricane or natural disasters, price gouging, it's almost like that. Price gouging is illegal, but a lot of times if there's a lot of people demands for the goods, but there's not enough goods out there, that means that too much money is out there. Too much demand means there's a lot of people with money to purchase it. Okay, but since there's not enough goods, then inflation can naturally occur. All right. Another reason of inflation is probably because one is supply and demand based. The other one is basically saying that, hey, if people want to make more money. Okay, so if workers want to make more money, that means the cost of goods got to go up in order to pay for the increase of wage. Okay, so those are like, so everybody wants to make more money, but when a company decides to pay people more money, one of the things to adjust the increase of wages, is to actually raising the price of goods. So over time, price of goods is going up no matter what, because people have to people have to make more money, and vice versa. If the price are going up all the time, that means people will continuously asking for higher wage, and then cost of goods will continue to rise. Okay, so it's really about how fast. Okay, inflation is inevitable. It's about how fast does it grow. Okay, so and people say competitions. Okay, if you got two companies or more, a lot of companies making the same goods, then competition can actually prevent cost of goods to go up. Okay, so imagine running out of toilet tissues. Okay, all of a sudden everybody buy toilet tissues, and all of a sudden there's no more toilet tissues out there. Then naturally people that have, there's so much money out there, people are gonna want to buy it all the time. So what happened if, just like when people say made in USA, imagine if we produce majority of our toilet tissue in United States, and we got toilet tissue made in overseas, made in China versus made in USA. Well, because competition, a lot of goods made it in overseas tend to be lower cost. Okay, we actually pay less money to purchase things, from overseas versus in USA. So can you imagine? Okay, can you imagine if there's a product that we purchase, like a toilet tissue, all made in USA? What that means is, even though you got a lot of different companies, okay, even though you got a lot of companies, let's say you got 4 different companies making toilet tissues, all made in USA, okay, yes, there is competition among the four companies, but because it's all made in one place, that means the price is going to be all high because of course the workers need to get paid. They want to make more money, then the cost of goods will stay high. So that's a natural inflation. That's the reason why, that's the reason why, when the United States doing trades, with other countries, part of it made stuff made in overseas can help us to lower the cost, that we have to pay as a consumer. Okay. So they're all somehow related. Um, the demand is one thing, people want to get paid, therefore, naturally the cost of goods will go up as well. Now, the toughest part the toughest part to swallow here based on this inflation idea is, um, you know, if the cost of, if we are paying higher wage, okay. Perfect example. Right now, the minimum wage in the United States is 7.25. If we go from 7.25 to, let's say, $15, I have heard $15 has become minimum wage. If this is like a federal law mandating all state got to do this, so that what that means is you have all these increase in price, you got all this increase in wages. So the company actually, you know, losing money. So when companies are losing money, then they can either raising the cost of goods that they are selling. The price of the goods are going to be higher. This is very, very natural. Either the goods will go up or they're just going to lay off people. Because used to you pay 2 people with 7.25. Now you're paying everybody 15, so that means they are losing over $7. So that means cut one person off. Okay, if I gotta pay this to one person, okay, if it was 7.25 for both, now I gotta pay 15. So that means one of these people got to actually lose his job in order for the company to actually pay the minimum 15. So the downside of inflation, okay, is actually it can cause, other than the cost of goods goes up, it can also translate into layoffs. So when companies are finding more and more efficient ways, to producing goods, that also means a lot of lower skilled positions will eventually go away. All right, let's take a look at this example. So let's say currently our hourly wage in 2020 is $15 an hour. So let's just pretend right now is $15 an hour minimum wage. If the annual inflation rate is at 5%, what hourly wage do you need to make in 2030 in order to keep up with the inflation? So let's say right now you are making $15 an hour. All right. And right now there's an inflation rate every year is at 5%. So from 2020 to 2030 is 10 years. So right now my time is 10 years. So 10 years later, what the question is asking is 10 years later, what do you need to make in order to keep up with the naturally occurred inflation? All right. So when you hear the word inflation, we got to use compound interest formula. So let me write down the compound interest formula. Remember, inflation is actually once a year. So if the n got to be 1, let me put 1 right here. What's r divided by 1? Is r. R divided by 1 is R. 1 plus R is 1 plus R. They're not like terms. You cannot combine them. P still P. What's 1 times T? T power. That's just why a lot of times when you see inflation, you're going to see this formula. This is just abbreviation of the compound interest formula. It actually comes from compound interest formula. It just N is 1. So we can just use this version of compound interest formula for inflation, making $15 an hour right now. It can be our minimum wage, or it can be your current hourly wage. Inflation is at 5%, and 10 years later, so that would just be T is 10. 15 times parenthesis 1 plus 0.05, raising to the 10 years, 10 power. So 10 years later, you will need to be making $24.43 in order to keep up with the inflation. So why do you need to keep up? Well, a dollar made today is going to be different dollar. Has a different value 10 years from now because of inflation. So if you're not keeping up with inflation, that in a way it means you are actually losing money. Okay. But a lot of times, I know a lot of folks work 20, 30 years, never got a single raise. Okay. Stay the same. They were making $10 30 years ago. They're still making $10 right now. But it's the way how they handle that money over time. Imagine $10 an hour, 40 hours a week for 52 weeks and for 30 years of working. What that means is they have gone through, they have handled this much money. Okay, that's $624,000 come through this person's account. Now I have seen people making this kind of money, which is not much for 30 years. All right, they invest it very wisely, and they can actually still end up with a decent retirement. Okay, it's about how we handle the money. Okay, once we got it. That's the reason why in previous classes I talk a lot about get rid of your debt or not get yourself in debt. Because imagine if you're not paying other people what you owe them, it means you get to keep majority of the money that you make. Okay, so in the next lecture we will begin to talk a little bit about borrowing money, and then we will wrap it up this set of materials with saving money. Okay, thank you for watching.